Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive right in. We're looking at one of the most polarizing stories in the market this year, ONDS Holdings, ticker ONDS. This isn't just a pivot. It's a complete reinvention, and it's all crystallized by the price action we've just seen.
It really is a phenomenal case study. You have a niche rail infrastructure company that has completely remade itself into an aerospace and defense firm focused on autonomous warfare. And the market's reaction has been, well, it's been driven almost entirely by the narrative.
And the event that really sets the stage for our debate happened on January 9th, 2026. ONDS priced a massive $1 billion registered direct offering. The price was $16.45 per share. And to really appreciate this, that price was a 17.5% premium to where the stock closed the day before. That move changes everything for the company.
That premium is the central puzzle here. But, you can't let it distract from the underlying financial reality. We are looking at a company with a market cap of roughly $4.56 billion. But then you look at their actual performance, their trailing 12-month revenue, and it's just $25 million.
Which brings us to the staggering number that really defines this whole conflict.
Exactly. A price-to-sales multiple of over 180. So that forces the question, does this huge institutional cash infusion, at a premium no less, actually validate ONDS as the next defense prime for autonomous systems? Or is a 180 PS multiple just an unsustainable bubble fueled by dilution and immense execution risk?
I'm going to argue that the premium pricing absolutely confirms the long-term strategic value. It gives them the capital, this what I call a fortress balance sheet, that is just essential to grow in this sector.
I see it very differently. Well, look, $1 billion in cash is obviously great for the company's survival. The extreme valuation and just the sheer complexity of the new capital structure, it just wipes out those benefits for existing shareholders. It exposes them to an unacceptable level of risk.
I understand the temptation to apply old-school valuation models here, but it's the wrong framework. We have to look at ONDS as an asymmetric, almost venture capital-style bet on future dominance. The market isn't pricing this year's earnings. It's pricing the convergence of M&A, of regulation, and defense modernization. The $1 billion lets them fund their operations, which, as you said, burned $26 million in just 9 months last year. They've essentially bought themselves years to execute and to grow into the valuation.
Buying time is one thing. Justifying a 184 times trailing PS is something else entirely. I'm sorry, I just don't buy that the public markets can sustain that. I mean, to put that number in perspective, even the high-growth SaaS companies, with recurring revenue, great margins, they trade at maybe 10 to 20 times sales. Established defense primes, they trade at a very sensible 2 to 3 times sales. ONDS is it's a complete outlier.
Strategic pivot is so coherent and, more importantly, unique. That's what the institutions are paying for. ONDS is building a true system of systems that speaks directly to what Western militaries need right now, like the DoD's Replicator initiative. They have the air component with American Robotics, which holds that critical FAA approval for Beyond Visual Line of Sight, BVLOS. They've got the ground piece with RoboTeam's UGVs. And then they have the protection piece with Centric's counter-UAS tech. No one else offers that integrated package.
I'll grant you the strategic appeal of the portfolio. The regulatory moat is real. But that $1 billion, it came at the cost of catastrophic dilution. The share count has just exploded. It's gone from around 70 million to what's estimated to be 380 to 450 million shares. That's nearly a 6-fold increase. So yes, the pie is bigger, but the slices for everyone who was already there are paper thin. And the company is losing a ton of money, $47 million in losses. This $1 billion just buys them a longer rope.
Well, that brings us to the first real point of contention then. What does this premium actually signal? The fact that sophisticated investors paid a 17.5% premium at $16.45 it's highly unusual. I mean, these deals are almost always done at a discount to get people in the door. This anomaly suggests huge conviction in the long-term vision.
That is a compelling point. And it's really the cornerstone of the whole bull case.
but I would frame the financial engineering a bit differently. A premium price sounds great, but when you include the warrants exercisable at $28, you create a very complex capital structure with all these competing pressures.
Let's stick with the upside of that for a second. That $28 strike price acts as a psychological magnet. It's an aspirational target that suggests the smart money expects the stock to more than double. That helps guide momentum.
I agree, it provides an attractive target, but the flip side is the immediate market mechanics. You have sophisticated investors who bought into the offering. They often engage in something called dilution arbitrage. They're essentially using their long position in the offering as a hedge against a short position in the common stock.
Okay, for anyone not familiar, can you just walk us through how that would create selling pressure?
Sure, by shorting the common stock, the institution can lock in an immediate profit and reduce their overall risk. They get cash now, but they still get to hold on to those warrants, which could be valuable down the road. This creates a kind of sustained, mechanical selling pressure that can completely offset the bullish news of the capital raise itself.
I'm just not convinced that simple hedging would outweigh the conviction from these new large holders. I mean, the sheer size of the deal, $1 billion. So just a level of commitment that goes beyond short-term trading.
Well, if that were true, we would see signs of an impending short squeeze. The short interest is high, yes, around 21% of the float, but the squeeze isn't happening because the cost to borrow, the CTB, is incredibly low. It's hovering between like 0.5 and 0.6%.
So why is the cost to borrow so low if the short interest is high? That seems backward.
It's the clearest sign of the dilution's impact. In a real squeeze candidate, the cost to borrow shares would be sky high because shares are scarce. The fact that the CTB is so low proves that the massive issuance of new shares, that 400 million plus share count, has just flooded the market with liquidity. Shares are easy to find and borrow, which makes it incredibly simple for funds to just sit on their short positions. So the dilution that's meant to fund the company is also what's keeping the shorts comfortable.
That's an elegant explanation of the mechanics, but it ignores the strategic value, which is our second and I think more crucial point of contention. The market is paying for the regulatory moat. American Robotics FAA approval for automated BVLOS, that's not just a technicality, it's an economic game changer. It lowers labor costs for customers and makes the whole drone-in-a-box model actually viable.
Right, the regulatory moat is a huge asset. I won't argue that. But the operational execution risk in trying to integrate 4 different companies, American Robotics, Air Robotics, Roboteam, and Centrix, across 3 different continents, the US and Israel, it's just immense. Merging all that technology and all those corporate cultures, it's a recipe for delays.
But that complexity is the value proposition. The addition of Roboteam's ground robots completes the air-ground picture. Their UTVs are used for specialized tasks, explosive ordnance disposal, ISR. This kind of interoperability is exactly what modern militaries are demanding.
I don't dispute the demand. I question the ability to deliver it fast enough to justify this valuation. And merging Centrix's CUAS tech, it's incredibly complex. Their cyber over RF protocol manipulation system for hijacking drones is brilliant, but
It is, because they're offering a clean cyber solution. You can't use jamming everywhere, and kinetic options are too messy for cities. ONDS lets you just take control of the enemy drone.
exactly, it's highly technical, but integrating all these specialized systems requires perfect execution from a company whose legacy rail business. I mean, the adoption for that was so glacial, it forced them into this massive pivot in the first place. They're now betting everything on this new unit, and there's just zero room for error. Well, let's ground this a bit. The legacy rail business is stabilizing. They've guided for meaningful adoption in 2026, so that could be a nice high-margin call option. But the main story is the interoperable defense product. Okay, so let's look at the gap. Let's compare ONDS to a proven peer, someone like AeroVironment, AVAV. They're a focused defense contractor. They make drones. They're profitable. AVAV trades at about 20 times sales. ONDS, again, is at 180. Just to match AVAV's relative valuation, just to get down to a 20x PS, ONDS needs to grow revenue by almost 1,000% in the next 3 years, and that assumes no more dilution. That financial chasm just shows you how much flawless execution is already priced in.
That gap reflects the asymmetric nature of the bet. And that brings us to our final point, management and sentiment. CEO Eric Brock. He's a former hedge fund manager. He is precisely the kind of capital market specialist you need to pull off a complex M&A roll-up like this and secure the funding. That's a skill set most product guys just don't have.
I see that point, and I agree he's good at raising capital. But his background also reinforces the critique that this is more about financial engineering than organic growth. And the optics of the recent insider selling are they're devastating. It suggests a total lack of confidence from the top, right when they were asking institutions to buy in.
You're talking about the December 31st sale? I agree. The timing is unfortunate.
Unfortunate is one word for it. CEO Brock sold 475,000 shares for $4.6 million. And yes, it was filed as a sell to toggle for taxes, which is normal. But doing that at the same time you're asking institutions to put in $1 billion at $16.45, it just screams that management sees the current price as an opportunity to cash out, not as a sign that the company is undervalued. And Director Ron Stern sold $6.7 million worth around the same time.
Still holds a significant stake, over 1.4 million shares, so he is still aligned. And you can't discount the retail momentum here, fueled by the strategic partnership with Palantir. That next Palantir narrative is powerful enough to overcome some of these short-term concerns.
But a narrative is not a business model, and comparing them to Palantir is just misleading. Palantir is an 80% gross margin software business. ONDS is a 33% gross margin hardware and integration business. They are fundamentally different economic engines, and relying on a $28 warrant to act as a psychological magnet isn't a plan for generating positive EPS, which analysts don't see happening until 2028 at the earliest.
But the market never waits for 2028. It prices the future today. The $1 billion raise at a premium shows the smart money agrees the strategic vision is worth this valuation as long as they execute. And now they have the capital to do it.
And we're back to dilution. The sheer number of new shares means that even if the company's total value grows 500%, the actual per-share price might only grow a fraction of that. Long-term holders are betting on an outcome that has to be absolutely perfect to deliver any real return.
The risk is extraordinarily high, I agree, but the potential reward, the chance to corner the market on integrated autonomous defense, is generational. It's the definition of a high-risk, high-growth bet.
Acknowledged. But the risk of a severe correction and shareholder disappointment is equally generational.
So, to just summarize our discussion, the core tension here is this. ONDS has secured its financial runway, it's validated its vision with $1 billion from institutions at a premium, which suggests a clear path towards that $28 target. It's institutional validation.
On the other hand, the market is pricing in absolute, flawless dominance at an incredible 184 times sales. At the same time, massive dilution and uncomfortable insider selling scream excessive risk and the potential for real per-share value destruction. The company is in a race against its own impossibly high valuation.
ONDS remains the definitive high-octane speculative name in this defense cycle. They've positioned themselves perfectly for what seems to be inevitable growth in autonomous defense spending. For those who can stomach the volatility, the potential reward here could be worth the risk.
I see it as a pure momentum trade, a venture capital bet that, based on its fundamentals and execution risk, just doesn't belong at this valuation in the public markets. The complexity, the timeline to profitability, it all means the current price is driven by a narrative that's completely divorced from sustainable value today.
And the real value here is understanding those two opposing forces, the fundamental bears who are focused on dilution and risk versus the momentum bulls who are focused on strategy and institutional validation. Those are the forces defining this battleground stock, leaving it up to the listener to weigh the evidence for themselves.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.